Raging Bull Awards 2 nights ago. So to Lyle and team, congratulations, and we are very glad to be associated with you. And may these well-deserved recognitions continue for a long time to come. I'd like to just position today's session a little bit more. So today's session is exclusively only for PSG Wealth, with a handful of advisors invited to keep the session small and focused, and ideally also interactive with questions towards the end. So this is absolutely a live session. So please excuse the warts and all if we do mess around with the technology that still bugs us a couple of years after getting very used to this during COVID. So our session for today's a presentation will be to keep this discussion relevant to how you use fixed income in your clients' portfolios, and also then PSG Asset Management's insights into the markets and how they articulate their views into their capabilities through particularly the PSG Income Fund and the Diversified Income Fund. This session, as you can see on the screen, will be presented by Lyle Sankar. And as I said, at the end of the session, we'll collate any questions that you may have put into the message box, and yeah, I'll collate all of them. If you don't want to ask them yourself, I'll collate them and ask them. Otherwise, you can just pop on your hand and ask the questions live when we get to that time. And so, Lyle, without further ado, I'm going to hand over to you.
Good morning, everybody, and thanks, Nadev. Good to see you all again. So I'll put together a fairly basic pack on the way we're seeing the fixed income market. I think it's fairly important to sort of just remind ourselves of our proposition and what we can bring to portfolios. And then a bit of a reflection on 2022. We think it was a big year for global fixed income, and it's going to mean that the years ahead is going to be quite different in terms of what we think most are expecting. Some very interesting themes playing out at present. Lots of optimism in the market, given the good start that we've seen. And then we'll talk a bit about what we're doing to add that little bit of extra edge in our multi-asset portfolio, the PSG Diversified Income Fund. And then we'll talk about where yields are in the market. So if I'll kick off, it's just a reminder of our proposition. And I think just to emphasize, we believe our edge lies in our behavioral approach to the market. So we typically will be the guys who would be buying when markets are very pessimistic, and obviously selling when there's lots of optimism. And you can see that in different pockets of the market, well-defined processes and a very clear philosophy that I think most of you are very comfortable with. From a team perspective, depth in team, stability, coverage across all asset classes. So we, in our PSG Diversified Income Fund, we're using 9 bottom-up buy lists, local and global, and that's what clients that use it get access to, and that's what we call this fully integrated investment process, where I'm sitting next to the equity guys, and they're utilizing our bond buy list, and we're utilizing their best ideas, local and offshore. And we think, from the global perspective, I think also just to point out, while we've done well on the fixed income side, the global guys also had a very good showing at the Raging Bull Awards, and I think some of those ideas in small size has been utilized in the PSG Diversified Income Fund, and it's added quite a bit to returns in recent years. So we think there's obviously strong portfolio construction is part of our toolkit, and we obviously trying to optimize risk-adjusted returns at all times. And we do look different from time to time, and I think we'll talk about 1 or 2 reasons why we think it makes sense to be slightly different now. But what we ultimately want to do, and particularly in the fixed income side, is generate that extra income for clients at very low levels of risk. So you guys are very, very used to the PSG Income Fund. This is the portfolio that, if you've got very short-term cash and, it's probably going to be there longer than 1 month, this is the fund that can get you that extra yield, give you that high capital preservation, very low likelihood of a short-term drawdown. And here we're talking about 1 month. So the feel of a money market fund, but better yields than that space on a risk-adjusted basis. So we talk about the average time frame of 1 year plus, but this fund, I think, it can serve as a shorter-term cash need. It won't really be the focus of the conversation today, but as you guys know, the performance track record has been fairly decent here. And just to point out, we haven't had any negative months when we're looking at the E-class, and really it's that feel of that safety of a money market fund, but with that extra yield. And today, as we look at the market, we think we can still add that benefit. Yes, cash rates are higher now because of the repo rate being up 3.5%, but we can add that benefit to clients because there's a lot of value a little bit further out in the curve, and I'll show you guys later. The PSG Diversified Income Fund, we'll spend a bit more time talking about this portfolio today. So this is the multi-asset income fund that competes against, the likes of, I mean, this is in the solution, but it competes against, the broader spectrum, and it's quite a wide array of portfolios. So for this portfolio, we're looking to take a bit of extra risk, a longer term time frame of 2 years, and really here we will lean into certain risks a little bit more. So it will have a bit more duration than the PSG Income Fund. Sometimes we'll have a bit more credit risk in the PSG Income Fund. But generally, this is going to be a very safe portfolio that can add that additional return. And we try to do it in a way that limits the likelihood of permanent capital loss, but also we've only had 2 negative rolling 3 months in the fund's history, so we obviously very cognizant of the short term journey as well. So the fund is targeting CPR plus 1. We think with our approach to markets, the behavioral edge, the way we look at 9 different buy lists in an integrated manner, we can asset allocate on our base bottom-up ideas to somewhere bridge clients between CPR plus 1 to 3 over time. And in fact, over rolling 2-year periods, the fund has done around CPR plus 2.9% over the last 9 years, which we think is quite attractive because one, as a core income fund, you can obviously generate very good income returns, but then also for clients looking for a bit more capital growth sometimes, and from time to time, the fund will deliver that without obviously compromising on capital preservation. So a key edge that we offer in the space is that we don't just use property alongside the fixed income. We utilize all our buy lists, and really it's that extra bit on top. So if fixed income in the next year is going to get us to 9%, which we do think you can get there, we're looking for another 0.5% potentially from the rest of these assets, and it's typically less than 10% of portfolio. So property, preference shares, local and global equities, and very small size. So that's the portfolio that also obviously did very well now at the recent showing at the Asian Bulls. But you can see over the very long term, there's almost 2% versus the peers, and we think that's because of the approach. But we think it's also in the category. It's also an area we can continue to generate alpha, and I'll talk to you really in brief about why we think that's the case on the next slide. So this we call our brag sheet, and really we want clients to put the portfolio in their back pocket and walk away for many years, because we think it's a very safe product. But really where we've generated a lot of value is the ability to focus on risk adjusted, so manage risk, but then equally try to be offensive when markets get too pessimistic. So last year was a great example. We had almost 5 bond market sell-offs where the bond market blew up by 1% higher in yields, and the fund can then actively participate in those things. The fund is also a lot smaller than the bigger fund, so it allows us to be a bit more nimble. We'll show you what we're doing in preference shares again. Some of the property names that we are buying, albeit small size for now, some of the larger funds can't really access. As I mentioned, we do use a wider toolkit, and you can see the addition to real returns over time in the fund doing CPR plus 2.9, which we think is quite attractive. And then obviously a strong focus on risk management, but balancing that we need to actually take risk in order to get that extra return. So we very, very happy with where the portfolios sit today. Both the income and the diversified income fund has obviously been good for clients, and we can see the market aid has been favorable for our style. And we expect good returns. So we'll get to the exact yields, and I know it's quite important to understand what the range could be around that. So in the next section, I think it's just really a reflection on 2022. Ultimately, we've been speaking about this inflecting market since COVID, and I think it's been a key message from PSG Asset Management on the fixed income side as well as the equity side, that we think there's this major unwind happening, which has both delivered volatility but also opportunities with that. And so some of the key principles that we're thinking about in light of this is obviously you want to have strong macro awareness, Typically, we are bottom up, but we do have obviously a strong focus on bringing in the macro. At this point of inflection, I think it's been quite important. Correlations don't typically work as you would expect, and we'll talk about that later. But at these inflection points, there's lots of value to be created. And I think, the broader message has been that we think this is going to be, the next 10 years is going to be very favorable for, some of the assets that we've already secured in our portfolios. The second point is just that left and right tail thinking, and this is just something we speak about, is that in these type of volatile markets, you want a strong focus on managing the left tail, so managing the scenarios where you get it very wrong, but you have to also focus equally on identifying the opportunity set that sits in the right tail. So we can use government bonds as an example. We actually believe that the market is too focused on what's going to go wrong in SA. A lot of that is priced. And if you are able to identify evidence that we are moving slowly in the direction of the right tail, we think you're going to set yourself up for very, very good returns. But valuation is going to be your first layer of defense. We saw that last year. If you're buying expensive areas of the market, there's lots of downside risk there. And we think in SA, we have the benefit of cheap valuations. On the fixed income side, that means very high yields. From the front end of the curve all the way to the long end, inflation-linked bonds as well. And so it will be your first layer of defense in a volatile market. And if you blend portfolios correctly, and I think this is something that we've managed to do well for clients, is get that combination right between inflation protection, inflation exposure, offshore and onshore, and that will help you in the years ahead. So we do think the market is too pessimistic, and that's what we'll bring to the table in terms of taking advantage of these opportunities. Most will, I guess, by now have had conversations about bonds being very cheap. We think the bigger question is not going to be whether you buy government bonds. It's going to be how much do you buy? Is this the market where you want to be sort of cautious, conservative? We don't think so. We think you actually want to be more aggressive than the average. And I think you can do that in a smart way when you think about your protections from valuation and blending assets with the non-correlated ideas that we can bring to the table. So we think it's actually going to be a very good environment in the years ahead. Last year was probably one of the tougher years. So on the point of inflecting markets, you would have seen this slide perhaps on our equity side. And I just want to point out the last two, or perhaps the last 3 points on the right-hand side, is we obviously have a very strong view that we think inflation is going to be around for a lot longer. In developed markets, it means that all those assets that benefited from very low rates and very low bond yields in developed markets, we don't think those will be the winners of the next decade. And for South Africa, our emerging market assets, which we could see just a small change in sentiment last year, performed extremely well. And our bonds, we think, are going to do well, where the margin of safety is already baked in. So we think the outlook is going to be more favorable, and it's particularly around commodity exporting emerging markets. And South Africa sits right in the center of that. So it was obviously a very difficult year, and I'm sure some might have experienced difficulty if you were in a typical 60-40 portfolio last year. You suffered quite a bit, and it was really the bond market that drove that. So we think the bond market's now alive to inflation. Inflation is not dead. What we're seeing from the market today is this call for a Goldilocks scenario where growth will fall, but not too much to hurt the equity market. Inflation is going to roll over now in the next couple of months because it had such a high base last year, but it won't, it's going to fall back to 2%. The Fed's going to stop hiking rates. And we think this is probably going to be right in the next 6 months, maybe a little bit longer, maybe to somewhere out in September. But then subsequent to that, we think the danger is that the market misses the point that inflation's actually going to be here, and there's many data points that indicate the view on the short term is absolutely spot on. Growth will slow, inflation will slow down. The odds are that the Fed will then come and say, we've won the battle here. And like we saw in the late 1970s, the exact same conversation ended up in disaster, where you get another oil shock or any external event, plus the real impact of wages coming through in the system, and inflation will probably be a bit higher than most are expecting today or pricing in. So bond markets today are essentially doing exactly what they did at the start of 2021 or at the start of 2022. And this is the performance of the bond market. So I just detailed some performance stats to the worst point, and it's just differs slightly in different curves. In the US and the UK, it was a bit of a disaster. I think the worst year in the bond market in many decades. You can see what a modeled 60-40 portfolio would have done. And despite the equity market only being down to worst last year, 22%, your bonds actually offered you no value. So what we're seeing is a lot of conversation about the fight against inflation is almost done. Going back to ideas that it's time to buy these bonds, it's time to implement these type of offshore ideas like the 60-40 portfolio. We think there's more risk there, and we would rather focus on where your margin of safety is. So, sorry, are you guys seeing just having an issue with slides? Are you guys on slide 4?
We can see slide 40 now.
Okay, that's great. No, that's perfect. So
sorry, can I see Blikkies has his hand up. Blikkies, do you want to ask a question? No? Okay. Continue, Lyle.
Yeah, so if you look at South African bonds in the context of what happened last year, we obviously had a tougher year. I think the bond market, the all bond index did about 4 and a bit percent. Inflation-linked bonds did about 4 and a bit as well. And the cash market did about 5%. So bonds underperformed cash. That hasn't been the case for many years. And what we just have on this chart over here is the all bond index returns. And 2015, you'll see, was a disastrous year. That was Nenegate. If you were in bonds at that point in time, you would have lost some capital. But then, it set the base for the subsequent, I think, 6 years of, on average, CPI plus 3 to 4% on the bond market. And obviously, the interesting thing is, despite everything that you recall in the last 6-7 years since 2017 or 2016, there's been a lot thrown at the bonds. The reality is you actually probably just earn somewhere near that starting yield, taking a longer term view. So we think this performance around 4% in 2022 is, in our minds, an anomaly. We think that sets the foundation for the years ahead. And so you can see you had consistent real returns, the black bars outpacing the CPI number in the dotted red line. And we think the base is now set for very attractive returns. But the key point over here is that the valuations actually mattered last year, because when you started the year, the bond market was about 9 and a bit percent on the 10-year. It ended 1% higher for the year. So it was a tough year for the bond market. But because you had that 9 and a bit yield, it protected your capital over the long term. So we think this such an underappreciated aspect is that, despite whatever you may be concerned about in SA, global and local factors playing out at the same time, you are being paid to wait. And we think the base is set quite well. So valuations protected us despite what happened in the bond market. But when we're looking at the offshore bond market now, and obviously then the derivative of that is that, the tech side, which is started really well on the premise that, rates are now settled, we think there's potentially more pain. And these are some simpler ideas that we think, obviously for multi-asset portfolios can do really well, but for a fixed income local investor, I think we set up for attractive returns ahead. And then, when we look at the SA space, which has been a really strong benefit for us, is that we've had both nominal bonds, so the fixed rate bonds offering high real yields, as well as inflation in bonds. And fairly complicated or graph over here. We don't have to go into the detail, but really what we're getting from these inflation in bonds is very high expected returns per unit of duration risk taken. So we're able to buy a lot of inflation in bonds in our fund, given the size, and it gives us a nice counterbalance where these bonds last year protected the portfolios against capital loss. So the market's gone into this view that South Africa's inflation is also going to roll very sharply. Global inflation is not going to be a problem, and the market really doesn't like these assets much right now. And we think that's actually a very great trade in terms of adding capital stability, because what's happened in recent years is if inflation is the main conversation. When inflation surprises to the upside, the nominal bonds get hurt. When inflation surprises to the upside, these do really well and at least maintain capital. So we've got the benefit of cheap valuations on both sides, as well as the benefit of being able to blend the two, which we've obviously been able to do in funds. So on the inflation itself, this is the actual inflation to December, and then this is the market's forecast, and this is the BER's forecast alongside the Reserve Bank's target. So you can see it's priced for perfection here. I wouldn't be too I guess I wouldn't be we'd be a bit more conservative on this, saying that we think you're probably not going to settle at a 4.5% handle. It just seems, I mean, that seems too perfect for us. We think there's offshore pressures. We think oil at $80 isn't going to be the longer term number. I think that would have been a clear message from our equity side, is the work they're doing there. There's still massive supply constraints in energy space. So we're looking at the inflation and say, well, the market's now gone through the peak of close to 8% inflation. It will roll over, but we think there's a bit of upside risk to this. So while inflation is going to be okay, it's going to be within the target band, we'd be thinking it's a little bit higher. But in general, the inflation is going to be fine. So this is the key question, because it will impact all of a local fixed income, particularly the front end, where the market prices these into interest rates. And as you can see on the next slide, this is the chart of the repo rate, as well as what the forward rate market is implying. And you can see in the green, as of somewhere late this year or early next year, the market's now implying we need to have rate cuts. So just to pause on this, if you have a view from the market that inflation is going to be very well contained at around 4.5% and be there for the longer term, you can make an argument that yes, the governor would look to cut interest rates. What I just want to highlight on this chart is that, and I think it's a really good thing for us as fixed income investors, is if you look at the period between 2015 to 2019, essentially the SARB just spoke about containing inflation, but they really didn't budge interest rates much. They kept the repo rate close to 7. At a low point just before COVID, it was about 6.5. So we think, in our view, that's a more likely scenario where the SARB's done a lot. They cut very sharply to support the economy, but then did a lot to catch up in the last year and a bit. And we don't think the governor is going to be of the mindset that now we know we're going to increase by 3.5% in 1 year, and then as soon as we get the chance, we'll cut again. He is naturally still a hawk, which means he wants interest rates higher to ensure inflation does get to 4.5%. So what that means is we're going to go back to the very sweet spot period for low risk fixed income of almost free real rates on cash rates. So once inflation does actually level out, and we'll probably pick a handle of 5%, maybe 5.25%, you're going to be getting close to 1.5% to 2% real from just being in cash. So we think that means the struggle that we had in COVID is probably past, and we're going to be offered obviously low risk return on the front end, and that sets a higher hurdle for when you decide to move further out in the curve. So we don't think the SARB is going to come at the back end of this year and cut rates. Obviously, rate cuts typically looks good for bond investors, but actually what matters is that inflation is contained and inflation's okay. And I think this will be good for the currency as well, which needs a bit of support today. So with that point of all those interest rate hikes last year, this is just the NCD curve. So this is a big part of our portfolios now. We were gradual buyers last year, and essentially you're getting between cash and 5 years out, you're getting all the way up to 9.5% now, because the rates are almost 2% higher than they were. So this is really good. It means for the income fund, for example, we can get yield enhancement that is more defensive, less volatile, very liquid from our big four banks, so very low credit risk. Actually, we would say almost none. And so we will offer a lot better running yield, And even today, where we sit, these instruments, we can roll the running yield consistently higher and higher, with your 1-year NCD now offering almost 8.8%. So it's a really good environment. I think most will remember this was what it was before COVID, high real rates on the front end. And look, I mean, I think while there'll be more benefit in money market funds, and you'll probably do around 6.5 to 7, maybe after fees on money market funds this year, we think that that value that you can get by going just a little bit further in a risk conscious manner is worthwhile taking. So money market funds are going to do better. Our money market portfolio is more excited because he's obviously his running yield is ratcheting up quite nicely. But from an income fund perspective and then a diversified income fund perspective, you can add quite a bit of value going a bit further out. So that's sort of where the curves are on the credit market. So what it means is now today when you buy JIBAR at 7.5 and you add even a very expensive credit spread, you're getting to an 8.5 return very quickly. So this is just an area that we think there's room for caution. A lot of the funds speak about having low corporate bond exposure. We're not seeing that because ultimately, whenever these auctions come, it's always oversubscribed, and the pricing gets even tighter and tighter. And this graph just shows you exactly what happened last year. If you think about 2022 and the volatility you experienced, in the red line, that's the spreads or the compensation for credit risk in SA. And then the other, the gray and the blue is what happened in global banks that are much higher credit rated. So their spreads blew out when the market saw pain. Our market just doesn't trade. And it's not really because we think it's a great feature of the market. It's just because it's really less liquid. And we think, a lot of clients will be sitting with this exposure, and it is an area that worries us quite a bit, because what you don't want is to lock up all your liquidity in expensive assets. And, you do get these events from time to time that can cause a lot of pain. So we have very little exposure over here. It doesn't compensate for fundamental risks. And we'd rather be focused on the government bonds. If you look at the government bond curve over here, our multi-asset team used this slide at their outlook. Essentially, the 10-year bond yield is 2 standard deviations away from its long-term average. So it's extremely mispriced versus where the bond usually trades on a stable inflation. And we headed into a stable inflation environment. You could add a real yield to that. You probably get to around 8.5, 8.7, but we are trading at 11%. So what the year last year gave us was an exceptional entry point. As I pointed out earlier on, I think that 4% return last year sets us up for very good years ahead. So to just summarize the outlook, I think it's obviously been very tough last year for global fixed income, but we think in SA you did quite well by having government bonds, blending that with NCDs, and then using inflation-linked bonds. We don't think inflation is going to be falling away. We would encourage everybody to think about beyond the next 6 months. You're going to get a lot of confirmatory evidence that the Fed's done and inflation's done. We think the opposite is going to be the case. The Goldilocks scenario puts a lot of investors at risk. But this is the trade that the market is pushing to make work. So your ARC innovation ETF, that thing is lifted off for the year. The Nasdaq's up. The bond deals have started well, but we can see signs that this is going to be an issue. In SA, we're not sanguine on the risks. We spend a lot of time, as I mentioned, thinking about the left tail, and then alongside that, trying to understand we can take advantage of too much pessimism. But SA does have very real risks, and we'll talk about the biggest one in brief next. But as you can see, we're fairly optimistic. We think this is great for income investors because on the front end you're getting 7 to 9% in yields that we can now buy. So every time, and we see growth, and I think it's going to be a very good opportunity for fixed income. We're not buying local credit. Local corporate bonds is not our favor, so we're very liquid. We're probably one of the funds with the least exposure in the market to corporate bonds. We'd rather be in SA Gavi. A bond risk scenario where you saw in 2015 you did almost 15%. Now, I've seen the calcs, but it's important to iterate. You don't need much from the bonds at 11, you're already doing CPI plus 6. If that bond yield comes down 1%, we're doing CPI plus 10 very easily. So we think it's going to be attractive, but let's be smart about how we blend these assets together. And then, as I pointed out, we're very concerned about this concentration in less liquid assets. A lot of the fixed income funds did a lot of structuring last year in a lower rate environment, and most of those notes, we analyze them, we look at it as an opportunity set. Most of those notes are both expensive from the underlying assets that they structure in, as well as the structure as a whole. And so we see some of those notes being deeply underwater now, and we keep it simple from our perspective, true to obviously what we're trying to promise on the mandate. So let's deal with the next question over here, and it's really trying to think about Eskom, because I think Pala seems like a year to 10 years ago. Seems like the market's forgotten. We are very we tried to stay close to it. There was a ruling yesterday that we're still trying to understand in terms of what the court's opinion is and what it means. But that's something that we think is one of the risks that we need to be monitoring. The budget is, as you say,
Aishal, do you want to ask a question there?
Maybe it was just an accident. So on the budget, we think the budget was actually really good in terms of what we wanted to see with Eskom. We think we got more than we got the quantum, we got the time frame. It actually works very well in terms of the conditionality. We've engaged Eskom, National Treasury on a one-on-one basis. And so the budget's fine. I think that's always typically a big fear for South African investors. Really, the big concern over here is Eskom and load shedding. And what we've got over here is very detailed, but we can share it with you guys afterwards. It's really just modeling what the energy requirement is versus what is available by Eskom. And you can see the first red line that's the deficit. So each 1,000 is a stage. And ultimately, with no action, we would get to stage 10 plus by 2030, just given plants will be decommissioned. And obviously, we assuming no renewables comes on board and Kusile and Medupi doesn't get fixed. But the reality is most of these things is going to come from self-help from Eskom. So they've got to fix the issues at those two major power stations, as well as then bring on all the renewables. So the first analysis is, well, if they get somewhere to fixing the issues at Medupi and Kusile, you move from stage 5 to all of a sudden in 2025 having positive so excess. Instead of load shedding, we'll have excess requirement, and that's on very low assumptions. We only get to 66% EAF, but that's assuming that the economy doesn't demand more electricity. So this is not us saying we're planting an optimistic picture. We're actually just saying what is in the pipeline, what is the commission trying to achieve. We think obviously 2024 is going to be very unlikely that they get all these things on board. But we're saying from 2025 onwards, the odds of us having this deep load shedding is less likely. Then, speaking to all the banking and the banking teams at all the major banks, just to get a sense about what projects they're financing, there's an array of different things that will come on board. And essentially, the private sector has been let loose on in the energy generation side. And you can see with the things that they have in mind, and more towards the end of 2024 and early 2025, we'll be well ahead of where we need to be in terms of demand versus supply. Now, the key points over here is that we will be constrained for the next 24 months. The outlook for the next 24 months isn't going to change. We're not going to be all of a sudden at stage 2 unless it's obviously going to be at least stage 3 to 4 for the next 2 years. And unfortunately, that has already been taken out of our growth estimates. It's been priced into the bond deals. We'll talk exactly about how badly South Africa has been performing year to date because of this. So our view is that the big delta happens from 2025 onwards. This is something that we're just going to have to accept. Obviously, there's some risks that it can get worse, But when we talk about on the next slide, we think the market's basically given it no chance of even stage 4 for the next 2 years. So there's a lot of stuff we can share any more detail with you guys. We did quite a detailed walkthrough of this with all the different stakeholders, but essentially the market's saying for the next 2 years, even stage 4 is optimistic. We think it's probably going to be the base case of a year, and it's something that I think South Africans have probably gotten used to. But we think the big delta sits in the private sector, and the private sector's got all the capital available. The regulation is slowly moving out of the way, very slowly. And then, as you saw with the budget now, essentially they've said to them, you guys can take over generation in future without telling that to the unions. And Eskom will essentially become a transmission and distribution business. But very tricky situation. For context, every other emerging market exporter, their currency is somewhere between 7 and 8% up against the dollar this year. South Africa is -5 against the dollar this year. So that's almost a 12% delta, 12-13% delta in the currency alone. And you'd argue that that's largely due to South Africa's energy constraints. So the way we're looking at it is, one, we've got cheap valuations. I think we all understand that from our bond deals. You can look at the currency market now and you can understand that South Africa is being punished. But really the base case view from what we gather in the market is that the market's saying at least for stage 4 to 6 in the expectations of growth, in the narrative that market participants are putting out there, because it's very complex, it's emotive. The sell side's written it off as being successful, low trust in government, low trust in this energy commission, very bearish views, alongside things that we've seen of late, like the Reuters interview, and more concern from inside government about sabotage and those kind of things. So we think the market's very pessimistic. We're not saying we are optimistic that we're going to have stage 2. We're actually making a case to say from this point of pessimism, you actually don't need stage 2 to make a lot of money from these bond deals. You actually just need some sort of stability around a level, say around stage 4. We're obviously worried about the grid in future, and I think that's going to be a case, and a lot of investments required, but the budget opens that up. Some things that could change it, if there was a decision made to use more diesel, we could actually drop 1 to 2 stages. Car powership, not very famous as a topic to discuss, but we can actually drop 1,200 megawatts off the shortage. And so there are things that can happen, but our view is that the market's priced this thing as a failure, essentially pricing South Africa into perpetuity at stage 6, and some participants even view it as higher. What we've seen from the private sector and dealing with the banks is that stage 4 is probably likely, and if you get there, then you don't need stage 2 to make a lot of money. So we're not sanguine on the risks. We think it's visible. It's in the price, but we need to be very close to this. And so we spend quite a bit of time, and hopefully as the year progresses, we can even share some content with you guys if you need it. So this is sort of the backdrop. Is SA's got this real invisible risk, and we think where we can then add value is try to use some of the other tools that typically isn't used in some of the fixed income portfolios. We'll talk about diversified income fund here. On the left hand side, the property market, we are not very bullish over there. Really, you can summarize the 2021 was a recovery of COVID. 2022 was a difficult year, very mixed performance, and we're seeing lots of value rather being selective here. Some things that have played out well is our investment in the tech. The PIC is entered and obviously boosted their net asset values. And then alongside that, this discussion of being nimble, we're seeing about 11% plus yields on preference shares. So the preference share market is essentially shrunk to almost 1, 2, or 3 names that we think we can access, because the banks are essentially out of the game now, having been bought back largely last year. But through Netcare, Discovery, and Grinnard, we're getting 11% plus yields, which is really good. The last time we were picking these yields up at these levels, it delivered very good returns for clients. So this is what we'll be adding to the portfolio. We think inflation protection as well as protection against these outside risks, because if the repo rate has to go but further upwards, these are going to offer coupons that are linked to that. So we're very excited about this, and we're trying to get more exposure as we go. With our fund size, we can still do it. What we're trying to do is obviously diversify offshore, and we just got this example of proper offshore bonds. What we're not giving clients is just exposure to the Bidvest dollar bond or the Eskom dollar bond. We're buying offshore bonds in the UK market or the US market. These are some of the ideas that either came through our property buy list or our equity buy list, and this just highlights the value you can get. So this example, we bought the bond at 700 basis points over a 4.5 year UK gilt, so at about 11.5. Subsequently, that yield has come in about 400-500 basis points. So that's really good return for short duration instruments in a company we know very, very well. And lastly, if you use your offshore well, we got an opportunity to take pounds, to buy pounds at 19, and now that's sitting at 21. So this is the type of opportunity set that we can unlock in the diversified income fund. Unfortunately, the income fund is local only, but this is the kind of thing that we think you could look forward to in the years ahead. I won't touch on this. We do use, as I mentioned, equities in small size, but it really is by the margin. It's not going to be a big driver. We have some great ideas on our buy list. Our equity guys are very excited still. Essentially, these stocks have priced the Eskom scenario in quite sharply, and we think there's a lot of upside available. But in combination, if you think about what we can bring on the fixed income side, plus what we can add in small size to these other asset classes, we think the sweet spot's going to be in that multi-asset income space. We think you don't have to go all the way to bond funds to get good yield. Our fund is, beaten the bond funds over the last couple of years, and I think, in fact, since about 2013, when we've been running this process, we've matched the all-be in return at a third of the duration, a quarter of the volatility. Why we like the multi-asset income space is because you can add these other asset classes. So if you have a bit of a longer time frame, it will make sense. So the positioning is really, this will change from time to time, but really just low credit risk, lots of exposure to government bonds. Today we have a running yield of about 9.1% on the diversified income fund, 8.3 on the PSG income fund, and that's growing. And we're comfortable that it's not going to be the highest running yield that you will hear in the market now. But remember, there's lots of risk in some of the structured markets. We're very happy. This is a very liquid running yield, and this gives you a sense of what could happen. I show this slide every time we meet, but in the middle, if nothing happens, you're going to get 9.1 and 8.3. We think the bond market's at least 1% too high, and then that's what the portfolios can do. And we think the range is going to be somewhere in between that. But if things do get disturbed this year, we think the funds, if you look on the left-hand side, even in a very, very difficult scenario, you're going to perform somewhere near cash. So very excited about what's on offer in the fixed income space. And just to emphasize again, this is the slide in the beginning. We're building optimal risk-adjusted portfolios here. I think we're quite asymmetrically positioned, and we do look different, and that adds quite a bit of value to the any solution. So I'll leave it there. Thank you very much for your time, Nadev. I don't know if you have any questions. I can't see anything on the chat, but maybe you have one or two things you want to discuss.
Yeah, perfect. Thanks, Lyle. I think that was well articulated, and it's great to see conviction being able to be implemented in the fixed income world. So maybe, I haven't prepped you for this at all, so apologies if it catches you offside. But in the fixed income space, being able to pick up on opportunities, some people say being a large fixed income manager is advantageous. Other people say being a small fixed income manager is advantageous. Where do you see yourself in terms of that size sweet spot, and what articulates that in terms of where you are unique to your peers in terms of what you can buy and select and build what you want with freedom to do so?
It's quite interesting because I think if you think back the last 15, 20 years, most guys would have told you, and it's really the life companies, they'll say, listen, we've got a large fund, we can go to the bank, we can go to the corporate, and we can say we want 10 basis points extra. Now, that probably was true in the past. Today, corporate South Africa, at least for the last 5 years, sits flush with cash. That means, what you've seen in the corporate bond market of spreads coming down, they don't really need our money that much. So for that advantage to play out, you need corporates in high demand of cash. And unfortunately, that's not the case. So one, I agree that that could be a benefit for guys. We don't really see that as an issue because if we want to do deals with any corporates, we can do it, and I think we're sizable enough across our portfolios to do so. But what it also means for those big funds is where do you go with your cash then? If you've got all that flow that has come, and I think we all know sort of where the flows have gone in the last 2-3 years. There's some funds that have grown massively, and well done to them. But what happens is you are forced to deploy that cash. So then in a spread market that's tightening, you have to continue buying and buying. And I think that's how guys get into a land bank situation where defaults. You get into African bank situation. Steinhoff was the same. Is you get comfortable with taking any yield. And the point I raised earlier on that JIBAR is already getting you to 7.5. So guys are willing to take any little bit of extra risk for that extra 1%. It's just not what we will do. Our benefit, though, I think, is if you compare us to the big guys. I mean, I could buy almost 30% of the short inflation-linked bond last year, which was the best performing bond in the whole market last year. The big funds can't do it. They cannot get that size. So we still have a liquidity advantage. We can buy preference shares, for example. That's a massive benefit where I could move from 0 to 3% in a week. The guys can't really do it. So I think it's typically what you would hear, but I think it doesn't really show in the numbers. If you see what I'm saying.
Yeah, absolutely. So you mentioned in your presentation that you're probably the one of the most bearish when it comes to corporate credit. What would change your mind in terms of corporate credit that you will start saying, okay, so I'm positive about corporate credit again?
So, our credit analyst and the co-manager on the diversified income fund will shout at me because it sounds like we're saying there's a default going to happen. And so we're running away from credit. We do like the asset class. We really do like it. In 2015, 16, and 17, we had almost 70% of the fund in that. That's our approach. If it's not cheap, we will get out of the asset class. Today, we have about 5 to 10%, and most of that sits in Eskom government guaranteed paper, which is essentially a call on the government. So from a pricing perspective, if we saw spreads start to move out, which is always your risk here, is that you get comfortable buying when it's expensive, and then when these spreads move out, it can be quite painful. We will happily then go back to the corporate bond market. It's when JIBAR's at 7.5 and you can get decent spreads, I think it'll play a nice role. But equally so, we must look at the government bond market and say, well, even on the 3-year bond we're getting 8.5. Then on the 10-year bond you're getting almost close to 11. So we've got to be conscious that we're not going to just buy corporate bonds. Then when it just gets over the line, it's got to compete.
Okay, good. And then maybe more from a financial planning perspective, I think, all the people on the call are financial planners. And one of the challenges that they've got is that clients need to beat inflation CPI. And traditional multi-asset portfolios have struggled for the longest time to give the inflation beating objectives that generally has been the order of the day. We talk about high equity CPI plus 5 to 6, etc. So it's very surprising and encouraging to hear that you are able to deliver out of the diversified income fund 2.9% above inflation since inception. So my question is, how do you think about inflation as something to beat your, do you think about it through the cycle? What length is a cycle? And how do you then land that expectation of we're going to try to beat inflation by 1% over a specific period, because inflation we look at in a specific way? Can you maybe articulate that view for the diversified income fund?
So I think maybe just going back one step higher than that is all our buy lists are real yield focused. So inflation plus a required return. So what that means is that we'll take a view on inflation. We're not going to be the guys that forecast, and you heard earlier now saying 5.25. Whether it's 5.14 or 5.21, it doesn't really matter to us. It's about understanding that from where we are today, where is the 3-year likely inflation? And in 5 years' time, what can we rely on from the Reserve Bank? So we take a typically more conservative view because it gives you margin of safety. We add a required return that we need. It's long-term, evidence-based. And then when we see opportunities above those required returns, it naturally means that we will always be looking to generate inflation plus returns. Now, for us, we've been lucky in recent years with the bond market just offering that upfront. So when we look out, we look at our buy lists. I mean, I think, like as I showed, there's just an array of inflation beating returns available, and that's not actually available offshore. It's not available globally. If you're in fixed income, I would be nervous if your fund manager said, I've got 20% offshore. For what? It's you know what I mean? Let's also keep it simple. We've got inflation plus 5 to 6 in the nominal bond market, inflation plus 4 to 5 in the linker market. Preference shares are giving you that. Equities are giving you easily some good inflation beating dividend yields. Property selectively might give you that as well. And then the cash market is there, 7 and 9% yield. So we are real yield focused, and this is our sweet spot. So we're very excited actually about it.
No, great, Lyle. So just one comment from my side before I hand over to Charles to close. So you mentioned the ruling around the Pala report came out yesterday, and you're still working through what the implications of this. So I just, for the audience as well, I had a conversation with Ronald King yesterday afternoon on what this means. So the ruling that came out is that the application was made to the Constitutional Court because Ramaphosa felt that it was a constitutional infringement that was placed on him, and that's why he took it to the Constitutional Court. The Constitutional Court said that he doesn't have a right to appeal because it's not the right forum for him to be appealing the ruling. So he needs to go to a different forum to get his appeal done. So it's not necessarily that it's throwing the baby out with the bathwater. It's just he will go to another court to get his appeal. So it, the media headlines and what it actually means is not necessarily the same thing. So hopefully that helps with giving some credence to what the announcement was yesterday. So Charles, can I hand over to you then to do closing for today?
Yeah, that's perfect, Dave. Lyle as well. I think maybe firstly, just from my side, I just want to tell all the PSG wealth advisors, thank you very much for your support over the last couple of years, especially when it came to the PSG Income Fund. We've really seen great support from that perspective. Then Lyle, yourself, the fixed interest team at PSG, well done with the Raging Bull Awards, where you've actually won the Raging Bull for the Diversified Income Fund for the best straight performance of the last 3 years. And when it's coming to the PSG Income Fund, I think what's even more important there is the fact that for the second year in a row, you've actually won it based on a risk-adjusted return over a 5-year period for the PSG Income Fund. So really well done with that. And I guess it's like the two of us always joke at the office. Everybody thought we were an equity house, but we are really coming through strongly from a fixed interest perspective. So really well done from that. And then I just wanted to show everybody quickly a one-pager. We will forward you the one-pager as well. It's a back-to-back one-pager that we've created for Diversified Income Fund as well as the Income Fund. So it's just got a little bit of static detail at the front about the fund risk profile, our investment philosophy, Raging Bull Awards. And then at the back, we've basically got the performance. Diversified Income Fund also includes inflation, and we compare it versus money market, and where you can actually see the blue line just going up of the PSG Income Fund versus the grey line, which is money market fund. So I just wanted to show that to you. Please give us feedback. We will forward it to everybody that have actually joined on the call, and just tell us if it works or what additional information you might actually need when you're sitting in front of your clients, because our aim is really to make it as easy as possible for you to move clients out of a bank account or out of money market into a fund like the PSG Income Fund. But then lastly, my side as well, we have applied for CPD points. So you should receive an email from PSG Asset Management shortly. And just to conclude, thank you very much for attending today. Nice week further your side. Bye.